How are you now? James here, VFS Group, to talk to you through a few of the things that are in my note this week and a few of the things that may be of interest to you. Put your phones on silent, please. Right, first and foremost, there is a push-pull that's going on in the market right now, and it sort of leads into what I was saying at the beginning of beginning of the year, end of last year, talking about that we're probably going to finish the year where we started, but it's going to be, inflation is too high, Fed needs to keep raising. Okay, it looks like everything sort of seems to be normal, the pivot's on. It looks like margins, and it's just going to be this sort of on and off about exactly what's going on. And the market will swing around in either direction. We've had an amazing January to start off with, and now February is starting to look like it's a bit weaker for a few reasons that I'll go into now. First off, inflation. Now, hey, if you want to talk about inflation, people are saying that inflation started to come down. The rate of change is slowing down. It's slowing down. It's slowing down. It's still really high, year on year. Okay, yes, it's coming off a base, but month on month, it's sort of petering along a little bit. But this is a bit of an example that I want to put in front of you here. This is the English breakfast index, and this is done by the Bloomberg people, and it just really shows exactly how much in the UK, exactly how much an English breakfast has changed in valuation. On average, 22%. You've seen milk has gone up 50% year on year. Eggs by the dozen, 29%. Eggs are just crazy around the world now. Even small things like sausages and mushrooms down the bottom, 7%, 40%. They've gone up. However, the UK apparently they've got inflation sort of under control, at least it's coming down, monthly. It does seem like it's actually sort of starting to be reined in. However, at the real level, it's actually a serious effect. So that sort of adds to this idea that the market is saying things are fine, or people are saying things are fine. The market is definitely not saying that things are fine because it's teetering off again, based on the fact that the Fed is trying to shake everyone and saying that it's not fine. We are going to continue raising for at least a little while, and until the data actually starts to change. The data has not changed, data has not changed enough or quickly enough, and needs to still get it back down. Don't forget that there's still at this 2% area they want us to try and get everything down to year on year. Right now it's still still really high. That's a thing that just needs to be paid attention to. Everyone sort of got it in their heads about a pivot. Everyone thought it was okay. Now it's time to start thinking about going underweight, or at least a couple of weeks ago it was time to start thinking about going underweight, last week for sure, and just sort of easing off some of this stuff, charging back in, and remember catching that up and down, up and down. The next one that I wanted to show you here. So ironically is that the FTSE is, I got it here. The FTSE is is at all-time highs. Now the FTSE is not representative of the UK, but this is just one of those great examples of you've got everything is sort of going wrong in one part of the world. Inflation is still really high. However, that market is actually pushing onto all-time highs. So I had the chart up here. This is from cut yesterday, so as at Friday. Have a look at that. Pushed on. This is FTSE, so we're talking energy companies, drug companies, European banks. It's all European companies. It's got very little to do with the UK. Don't worry about that. However, it's just an interesting food for thought that market is still pushing on after being so deeply damaged when it was during Brexit for some reason, and also during what was that other thing that we had where we all didn't get sick? COVID. So that's another interesting thing. So it's just sort of interesting. Now we're long F100, which is the FTSE 100 ETF. That one is a good one, and we've been long on accounts like that for a while. Should have really doubled down on it when FTSE was at these lows instead of just staying the course, and that's it. However, that chart doesn't look too bad. I'd be happy to thin some out, probably if it just keeps on pushing on a little bit further up, which based on the weird topsy-turvy world that we're in right now is probably not going to be too far away. However, now let's talk about breakfast. Oh my goodness. The Wall Street Journal has a solution to your expensive breakfast problem. Don't eat it. Thanks, guys. Very helpful. Completely. I can't imagine anything more tone deaf than this. To save money, maybe you should skip breakfast. Thanks, guys. We will keep that in mind. People need to still eat. Please continue to eat breakfast, especially if you're a young person. Very important. But you can sort of see now where the press, what do you want me to do? You want me to eat? Apparently during COVID, and as people were rebuilding after COVID, the papers came out and said that millennials weren't spending enough going out, so they couldn't rebuild the economy. It's just like you've just spent years telling people they're eating too much avocado toast to be able to afford a house, and now you want people to go out and spend money, and then look what's happened when people have gone out and spent money. Inflation has gone through the roof. It's just insane. However, look, that's how that goes. There was something else that I wanted to put in about Taiwanese exports. Taiwanese exports are showing strength. Remember, Martin Wetton did comment on that. Look, I'll pull it up for you at the end, and we'll get to it. But I remember that was another thing that I was going to talk about. Look, let's get to it in a sec. Now, the Bank of America Fund Manager Survey came out last week. It dropped. It sort of got messed up with all the CPI stuff, and everyone was worried about CPI data last week. It's all been forgotten now, obviously, but the CPI was in line. But when the Bank of America Fund Manager Survey came out, everyone pays attention to it. It's got like $500 billion of funds under management contained within. So these are actual fund managers giving their actual positions and views on what they think the market is doing. Phenomenal, exactly what they say is happening. It's, for the first time in forever, it's turned down. In the recessionary fears, recession fears are down sharply. There is a net percentage saying the recession is likely in the next 12 months. It was really high at about that 70-something percentage mark. I had it here exactly what it was. It was, doesn't matter, but however, that's turned down really sharply down to about, I think, a 24% area. I had those numbers written here anyway, but you can just see the number of fund managers who think that they were going to see a recession this year or going into the early of next year is now way down. That's interesting. That shows that there's more confidence in the economy to have a soft landing, not a hard landing. And that's sort of where people are saying. And everyone's talking about landings now. It's really painful to watch. So, look, that's what we've seen. Along with that fact, we've also saw in the fund manager survey, two-thirds of participants think that what we've seen in the US has only been a bear market rally and not the start of a new bull market. That's a pretty important one that really needs to be paid attention to. That's a majority of fund managers, and these are some serious professional dudes, think that what we've seen over the last, from the end of December to now has been a bear market rally, and so then the bear market will continue. Another warning signal out there just to make sure that you don't have too much invested in the market right now. Now, here's the big thing. We've seen a lot of earnings and a lot of reports. And one of the key trends that's kicked on has been about a 5% quarter-on-quarter decline in earnings per share, which is down about 5%. One entire percent of that, 100 basis points, however you want to say it, one entire percent of that has been margin compression. Margin compression. I'll say it again. Margin compression, because it is important that companies' margins are their lifeblood. Without your margins, you're absolutely stuffed. This is exactly what margins have looked like quarter on quarter. Pay attention here. Net profit margin of 13% at the peak in 21, dropped down by points, all the way down, and now we're looking at a net profit margin, which is now, almost 2.5% lower than where they were. That's a huge number for companies. There's a big kicker that, and this is the quote that I loved, of an anonymous person on Twitter who said this: "It's going to be sickly funny when corporate caution on staffing levels in order to protect margins is what causes the economy to turn down, rather than a rates-led demand hit that isn't coming." A phenomenal thing that is just said. So it'll be companies, listed companies, they do have to protect their margins at all costs as best they can. The fact that they've let them squish here is just sort of going back down to normal areas. However, they're not as high as they were. But as they continue to try and protect those margins, that's probably what's going to start to affect the economy, as opposed to this demand suction, a pullback in demand that was supposed to come from rising interest rates so much. It's actually going to be the margins that they squeeze into. Look, I'm going to wrap this up really quickly because I've got. Where I'm saying it is that because of these particular facts, that you need to be buying quality, because quality companies, so there's a quality ETF, QHAL is the one that I prefer. Quality companies are better at protecting their margins. They've got low debt, they've got a more consistent return on equity, and if you've got a more consistent return on equity, so if you can continue to persist at that, you are better at protecting your margins. It's just a fact of life. That's just how it goes. So look, don't go out and charge in to buy it now. Again, the theme of my note this week was don't need to be a superhero. Don't charge in. The market will pull back. You'll find a nice place to do that. Look, that's all I've got time for today. Have yourself a great everything wherever you are. Keep an eye on Walmart earnings tonight if you're actually watching this now. I do believe, here's the thing, I think that they'll be up, and I think that Walmart will beat and it will continue higher. They're reporting before market tonight, so there's not much you can do about it. Have yourself a good one, and I'll talk to you later. Bye.